the housing market is sending shockwaves through the South, and while the headlines in most mainstream outlets still talk about balance, resilience, or soft landings, the truth on the ground tells a very different story. If you live anywhere in Florida, Texas, the Carolinas, Tennessee, or Alabama, you've probably already noticed more for sale signs sprouting up, more price reductions flashing on listings, and more homes sitting unsold for months at a time. The Southern housing market is not quietly cooling. It is in the middle of a painful, accelerating collapse that few saw coming, and even fewer want to admit. Zillow, Redfin, and the National Association of Realtors continue to project national growth of 2 to 4% in 2025. They use words like stabilizing or healthy adjustment. But ask the homeowners in Cape Coral watching their property values sink, or the buyers in Austin being offered $50,000 incentives just to sign a contract, whether this feels like stability. The data doesn't lie, and once you connect all the dots, it's clear the South is experiencing the sharpest housing downturn since the last financial crisis. Let's start with Florida, because it's ground zero for this unfolding collapse. Florida's real estate market soared in the aftermath of the pandemic, fueled by remote work migration, retirees escaping northern states, and investors piling in with cash. Cape Coral, Fort Myers, Tampa, Orlando, Miami, these were markets where homes sold in days, prices jumped double digits, and bidding wars were the norm. But today, the story couldn't be more different. Florida now leads the nation in foreclosures, with 1 in every 267 homes receiving a foreclosure filing in 2024. Lakeland tops the list with 1 in every 172 homes in foreclosure. Cape Coral is also near the top. Cape Coral and Fort Myers, once the epicenter of Florida's growth narrative, have seen home prices plummet 11% over the last 2 years. That may not sound as dramatic as 2008, but remember, so many buyers purchased at peak valuations with minimal equity. Nearly 8% of local homeowners are now underwater. They owe more than their homes are worth. That's the highest rate anywhere in the country. At the same time, the number of homes for sale has exploded, with more than 14,500 listed compared to just 5,500 last year. That's a 160% increase in supply. Over half of those listings have already been marked down in price. Sellers are slashing, but buyers are not biting. Then there's Florida's insurance crisis, which is fueling the collapse. Premiums now average over $11,000 a year, the highest in the nation, forcing many owners to list properties they can no longer afford to maintain. Add to that an economy where wages aren't keeping up with costs, and it's no surprise homes are now taking 70 days to sell, up nearly 2 weeks from last year. Condo values have crashed 6% year over year, single-family homes dropped to a median of just over $400,000, and more than 30% of sellers statewide are reducing their asking prices. Florida's market, once the strongest in the nation, is now one of the weakest. Texas tells a similar but slightly different story. Austin, once the darling of the national housing market, has suffered one of the steepest corrections in the country. From the June 2022 peak through May 2025, prices dropped 23%. Inventory has ballooned, with listings up 70% compared to 2019. Nearly 30% of sellers are cutting prices, and active listings vastly outnumber pending sales. The frenzy that once made Austin untouchable is gone, replaced by hesitation and growing losses. Dallas-Fort Worth is no better. The region now has more than 30,000 active listings, a 67% surge year over year. This market went from 1 month of supply in 2022 to 3.5 months today. Sales volumes are down, confidence is evaporating, and nearly 1 in 3 listings has seen a price reduction. What's truly shocking in Texas is the builder panic. Leonard disclosed that in some Texas markets, the average incentive per house now exceeds $51,000. D.R. Horton, America's largest builder, has seen its margins fall as more than 80% of buyers rely on mortgage rate buydowns. In the first quarter of 2025, over 70% of Texas sales included price cuts of $5,000 or more. These are not token discounts. These are signs of a market in freefall. When 7 out of 10 buyers are negotiating thousands off the sticker price, builders aren't in control. Buyers are, and builders know it. Now, add another layer to the crisis. Institutional investors are running for the exits. CoreLogic data shows investor market share peaked at nearly 30% in January 2025 before plunging to 23% by June. That means 1 in every 4 homes that used to be bought by Wall Street or large firms is no longer being purchased. Invitation Homes turned into a net seller in 2023, offloading more properties than they bought. Open Door, once the face of the iBuyer boom, saw transactions collapse 58% from 2022 to 2024. The company cut 17% of its workforce and is facing potential delisting as its stock trades near $1. OfferPad faces similar struggles. Florida has been hit hardest by this investor exodus. Orlando saw investor purchases plunge more than 27% year over year. Miami fell 21%. West Palm Beach dropped nearly 15%. Cash purchases, a proxy for investor activity, are at a 3-year low nationwide and falling fastest in the southern metros. When the so-called smart money exits first, it usually means they've seen data the public hasn't fully processed yet. And right now, the message is clear. Big investors believe southern markets are too risky. But it doesn't end in Florida or Texas. The Carolinas are showing the same signs. North Carolina's statewide sales volume dropped nearly 11% in 2024, while inventory grew almost 13%. Charlotte's inventory is up 27% in a single year, and days on market are climbing. Durham saw median prices slip, while days on market surged more than 100%. Even in markets once considered bulletproof because of universities, jobs, and tech hubs, cracks are spreading. South Carolina's sales volumes are down nearly 9%. Charleston, which experienced years of double-digit price growth, now shows 0% growth in 2025. Over a third of listings in Charleston County have price reductions. Nashville, Tennessee, once one of the fastest-growing cities in America, has seen inventory jump 29%, while sales dropped 18%. Alabama has recorded its lowest home transaction levels in years, with sales down 18% in 2024 alone. And then there are the contract cancellations, a hidden sign of collapse. In January 2025, 14.3% of pending sales fell through across the South. Atlanta saw nearly 20% canceled. Orlando was at 18%. Houston and Jacksonville were both near 18% as well. Imagine signing a contract, putting money down, then walking away. That's how little confidence buyers have in these markets. They know more supply is coming, they see prices dropping, and they're not willing to take the risk. So, what are the warning signs that your local market might be next? The first is inventory growth of 20% or more year over year, while sales volumes decline. That's the classic formula for falling prices. The second is when more than 30% of listings are cutting prices and days on market are climbing. That's the seller capitulation phase. And the third is when cancellations exceed 15%, while cash purchases decline. That signals confidence has collapsed and investors are pulling back. If you see these 3 indicators, you're looking at the early stages of a downturn. And here's the truth. This isn't just a regional problem anymore. While Zillow predicts 2.6% growth nationally, more than half of the homes for sale in America are in the South. The South accounts for more than 54% of housing starts, but it also accounts for the highest foreclosure rates, the sharpest price declines, and the most dramatic incentive packages. National averages are hiding a regional catastrophe, and if this contagion continues, it won't remain confined to the South for long. The Southern housing market crash isn't coming. It's already here. From Florida's skyrocketing foreclosures and underwater mortgages, to Texas's desperate builders, to the Carolinas' collapsing sales, and Tennessee's exploding inventory, every indicator points to a market that has already tipped over the edge. Families are struggling to hold on to homes, investors are abandoning ship, and builders are throwing cash at buyers to stop the bleeding. While national organizations talk about balance, the reality for millions of Southern homeowners is falling equity, rising debt, and the highest foreclosure rates in more than a decade. The question is no longer whether this is happening. The data proves it beyond doubt. The real question is how deep it goes, and how many other regions are pulled down with it. If history has taught us anything, it's that housing downturns spread. They start in a few markets, then ripple outward until they touch nearly everyone. Right now, the South is the epicenter. Tomorrow, it could be the Midwest, the West Coast, or even parts of the Northeast. So if you're watching what's happening in your own neighborhood, more listings, longer selling times, price reductions that keep stacking up, you're not imagining it. You're seeing the early signs of the same collapse already hitting Cape Coral, Austin, and Charleston. And if you're wondering whether this is just a correction, the answer is no. The depth of foreclosures, the scale of price cuts, the retreat of institutional buyers, and the desperation of builders all point to one conclusion. The crash has begun, and it's accelerating. This is not speculation. This is documented fact, pulled from ATOM data, CoreLogic, the Texas Real Estate Research Center, and multiple MLS systems across the South. The disconnect between what major real estate companies are saying and what's really happening is one of the most dangerous misreads of housing conditions since 2008. The families living through it know the truth, and sooner or later, the rest of the country will have to face it too. The Southern housing market crash is real, it is spreading, and based on every indicator we have today, it's only just getting started.